Welcome back to the deep dive. Today, we're plunging into a topic that's, well, both critical and maybe a little uncomfortable for many large organizations: digital transformation in banking. You hear banks everywhere claiming they're making huge strides, but what's really happening, beneath the surface? Are they truly evolving, or maybe just putting a fresh coat of legacy lipstick on old problems?
That's a great way to put it. Legacy lipstick.
Our source material for this deep dive is an insightful article called Legacy Lipstick: Why In-House Team Struggles with the Digital Innovation in Banking by UXDA. They're a global leader in financial user experience design.
Right, and they've got some really compelling case studies and analysis to back it up.
Exactly. Okay, so let's unpack this. Our mission today is to dig into why genuine digital transformation in these large retail banks often gets, well, stuck, despite having bold ideas,
Wow.
and explore what it truly takes to succeed. We're going to confront this central tension here, that common belief inside banks we can do this ourselves and probably do it best.
Right, the in-house is always better idea.
Right. Versus the sometimes harsh reality of years of lag, mounting product debt, and frankly, an exodus of their best people and customers just fleeing to the nearest fintech.
Yeah, and what's fascinating, as the article points out, is that this silent struggle, it isn't just about the tech or even about having enough money.
Oh,
It's fundamentally about mindset.
yeah.
Many banks operate within these invisible walls built from legacy patterns, a deep aversion to risk, and maybe this illusion of control.
Invisible walls. I like that.
And these barriers, they often prevent them from truly seeing beyond their own internal limitations, even when the world outside is just changing so rapidly.
So it's like they're trapped in their own history, almost.
In a way, yes. And the core truth we need to recognize, which the source really hammers home, is that in-house doesn't automatically mean in shape for digital innovation.
Right. Just because you can do it doesn't mean you're equipped for this.
Precisely. Even the most passionate, most capable internal teams, they simply cannot shoulder the full weight of genuine digital transformation alone. Getting that agility, that personalization, building deep trust today,
Yeah.
it requires bold collaboration, a truly digital native approach, and honestly, genuinely open-minded strategies. This isn't about forming, one more internal task force.
So, yeah, another committee.
It's about enlisting what they call special forces.
Special forces. Okay. That makes so much sense. It's not just about the tools, but the whole way they think about solving problems. So if banks keep going down this path without that genuine evolution, what are the truly critical, real-world consequences they're facing?
Well, the stakes are incredibly high.
Beyond just market share, what's really at stake for them in the next, say, decade?
If banks fail to evolve properly, they will maybe inevitably forfeit their role as trusted financial services providers. Just think about it.
Right.
Customer loyalty in the coming decade. It's going to hinge squarely on things like proactive guidance, totally seamless omni-channel digital experiences, and transparent AI-powered insights. Stuff that requires deep specialization.
And if they stick to the insular approach?
Then you get these significant long-term risks piling up. We're talking about chronic customer attrition.
Meaning the customers just leave?
They'd just migrate to fintech alternatives, those agile tech companies disrupting everything, because they offer a superior user experience. And that leads to sustained revenue decline.
Okay, that's bad. What else?
Then there's escalating technical debt, where Band-Aid fixes just bloat the old legacy systems.
Covering up the cracks.
Exactly. And that basically creates hidden future costs or problems that will need fixing later. It results in skyrocketing maintenance costs and, crucially, a much higher risk of system outages.
Right, which kills trust instantly.
Instantly.
Yeah.
And then you see talent drain and cultural stagnation. Your high-performing employees, they leave. They go to environments where they can actually learn and experiment.
Taking all that institutional knowledge with them.
Precisely. It erodes that valuable knowledge base. And this also brings regulatory and security vulnerabilities. Outdated tool chains, siloed compliance processes. They just heighten the likelihood of data breaches or big non-compliance fines.
It's a perfect storm, almost.
And ultimately, there's the huge risk of just competitive irrelevance.
Yeah.
Insular banks risk becoming, commoditized service providers, while their peers are busy leveraging AI and personalization to set completely new industry benchmarks.
Wow. So it's not just about losing ground, it's potentially losing their fundamental reason for being in the financial ecosystem.
That's the core danger.
It sounds absolutely critical for banks to address these product development blind spots, as the source calls them, if they want to keep their market share, protect their brand, secure growth capital.
It's foundational.
It's not just about staying afloat, it really is about staying relevant.
Absolutely.
And this brings us neatly to reframing the path forward. The source material makes it really clear that true transformation requires acknowledging these 5 uncomfortable realities, or blind spots. And it emphasizes that it's not actually a weakness to seek external help. In fact, it's framed as a competitive advantage.
Precisely. Achieving world-class customer experiences, truly adaptive architecture, AI-driven intelligence. It demands a blend. You need that internal dedication and external specialization.
Blend, okay.
And this fundamental shift, it doesn't just accelerate delivery, it also significantly reduces long-term costs. It empowers the internal teams, strengthens customer loyalty.
So it helps everyone.
Ultimately, yes, it ensures long-term relevance in a market that, let's be honest, simply won't wait. It's all about outpacing stagnation.
Okay, let's dig into the first blind spot then. The myth of in-house mastery. There's often this assumption, right, maybe from senior leadership, that decades of institutional knowledge automatically equate to cutting-edge capability.
Yeah, that's a common one.
But the reality is, in-house teams often spend years just patching legacy systems, focusing on tiny, incremental fixes.
Firefighting, basically.
Yeah, leaving little room for deep specialization in areas like AI or advanced UX data science. So what are the, practical consequences of this, and how can banks really assess where they stand?
Well, the practical consequences are pretty stark. Skill gaps just widen over time, and this sense of innovation fatigue inevitably sets in. Your internal teams might genuinely lack experience with modern design systems or, say, machine learning toolkits they need now.
So what can they do about it?
To address this, the source suggests banks can implement internal skills audit workshops. The goal is to identify concrete areas where literally no team member has hands-on experience, like nobody here has ever shipped an AI-powered recommendation engine.
That's specific and honest.
Very. Benchmark exercises are also powerful. You assign sub-teams to try and recreate a leading fintech UI using only their internal methods. Then you document the time, the roadblocks, the quality. It illustrates the shortfalls very clearly.
Ooh, that could be revealing.
And finally, probably the fastest way, is an external versus internal UX audit. You commission an outside agency to perform an audit in parallel with an internal team, then compare the findings. It exposes capability gaps brutally honestly.
Those audit strategies sound incredibly insightful. But what are some of the biggest hurdles banks might face when trying to implement something so transparent internally, like pushback?
Oh, absolutely. The biggest hurdle is often a reluctance to admit limitations, or maybe a fear of what those audits might actually expose. It can challenge long-held beliefs about internal competence.
Yeah, egos can get involved.
They can. That's why the whole process needs to be framed very carefully, not as a critique, but as a strategic path to actually strengthening the team and securing the bank's future.
That framing is key. Okay, that makes perfect sense. Now let's move to the second blind spot, exposing the false economy of DIY innovation. We often hear the cost-cutting argument against bringing in outside help, right? But the source makes it clear why this is often a false economy. It seems almost counterintuitive, doesn't it? That trying to save money now can become this expensive drag on growth later.
It absolutely is counterintuitive until you really break down the true costs involved.
Okay, tell me more.
These hidden costs include, first, longer timelines. Recruiting specialist talent or upskilling existing staff takes months, sometimes longer. That delays your time to market significantly.
While competitors are launching.
Exactly. Then there's technical debt accumulation. When your internal teams are stretched thin, they inevitably introduce workarounds, hacks, things that just bloat future maintenance costs down the line.
Kicking the can down the road.
Pretty much. And crucially, there's the opportunity cost. While your internal resources are still tinkering, trying to build something, your competitors are deploying polished features to actual paying customers, capturing market share you could have had.
Ouch. So how do banks get a handle on those costs?
The total cost of delay, or COD analysis, is vital. You project the deferred revenue you're losing from new users by not launching versus doing a faster, maybe outsourced pilot project. You express it in real terms. Projected fees, reduced churn, increased efficiency.
Make it tangible.
Make it tangible. Banks should also maintain a formal technical debt ledger. Actually log the hacks, the patch jobs, and assign estimated remediation costs to each one. Shine a light on it.
Wow, okay.
And finally, an opportunity cost dashboard. This can contrast your internal sprint outputs against what peer banks or nimble fintech partners are achieving. It really helps evaluate that eroded competitive parity.
This distinction between loyalty and leadership you mentioned earlier is fascinating. We value commitment so much in internal teams, but the source suggests commitment isn't always enough for truly cutting-edge innovation. Can you break down why that difference is so crucial? This is the third blind spot, right? Confusing loyalty with leadership.
It is, and it's a really crucial distinction. Let's contrast, say, a bank's lifetime experience with internal projects against a specialist crew, like UXDA mentioned in the source.
Okay.
They've designed over 150 financial products, end-to-end, across retail,
Right.
wealth management, SME banking, even crypto.
Wow, 150.
Yeah. They've worked in 39 countries. Think about the regulatory nuances, the cultural habits, the UI conventions they've absorbed from that global exposure. Stuff a single market internal team simply won't encounter.
That breadth of experience is huge.
It is. They've tested and refined literally thousands of patterns, widgets, AI-driven flows,
Right.
and turned them into playbooks that can shave months off delivery time. And critically, they compete daily on the open market. For them, speed and ROI aren't just workshop buzzwords, they're survival skills.
That's a powerful point, survival skills.
Right. So internal passion, it's priceless, absolutely. But it cannot match the focus, repetition, and that cross-market pattern matching of a purpose-built UX strike force.
So it's about different strength.
Exactly. In-house people bring vital institutional memory. A leading UX agency brings a proven global competitive edge. You blend them, and then you get loyalty plus leadership. That's the mix that wins in the next decade.
And how can banks address this specific blind spot?
The source suggests a few things. Conduct an industry benchmark. Capture the UX patterns and KPIs from, say, the top 10 highest-rated banking or fintech apps globally, and score your own app side by side. Be honest about where you stand.
A reality check.
A necessary one. Then, commission a best practice gap audit from an agency. Get them to do a heuristic plus analytics UX audit to flag missing standards and features, and crucially, translate those gaps into concrete business opportunities.
Turn gaps into opportunities. Nice.
And finally, try a concept reboot lab. Embed an agency within one of your sprints to craft a future state prototype. Pair your internal designers with the agency specialists. It's an amazing way to transfer knowledge directly.
That really drives home the idea of specialized expertise. It's not just about doing the work, it's doing the right work, informed by all those global insights. Which leads us nicely into the fourth blind spot. Framing outsourcing not as a failure, but as a strategic accelerator.
Yes.
The source says forward-thinking organizations recognize that these targeted partnerships can actually speed up innovation without eroding the internal culture. But how do you prevent that internal culture from feeling, threatened or bypassed by bringing in external teams? That seems like a real challenge.
It is a valid concern, and it really comes down to being intentional about the strategy.
Yeah.
External partnerships act as powerful accelerators in a few key ways. First, they provide on-demand talent pools, UX researchers, AI engineers, accessibility specialists exactly when you need them.
Filling those skill gaps quickly.
Instantly. Crucially, they facilitate rapid knowledge transfer. This happens through collaborative sprints, embedded coaching.
Yeah.
The goal is to elevate the in-house capabilities so the benefits last long after the external team departs.
So it's about upskilling your own team, too.
Absolutely.
Yeah.
And third, they offer objective audits. They look at customer journeys, tech stacks, with fresh eyes, uncovering hidden friction points that internal teams might have just gotten used to or normalized over time.
Fresh eyes are so valuable. What are the strategies here?
Well, you can start small with micro-consulting sprints. Contract an agency for a short design sprint focused on one high-visibility feature, maybe the onboarding flow. Require clear deliverables like user test videos and clickable prototypes that executives can see and touch.
Get some quick wins.
Exactly. Build momentum. Also, structure external engagements with formal knowledge transfer mandates. Include specific teach-back sessions, require thorough documentation, run workshops so your internal teams can actually replicate the key processes themselves later.
Make knowledge transfer part of the deal.
Make it explicit. And finally, propose an innovation credit budget line. A dedicated fund just for specialist partnerships, framed internally as an insurance policy against project blockers or unforeseen challenges.
An insurance policy. I like that framing. Okay, and finally, the fifth blind spot, and maybe the biggest hurdle of all, overcoming executive skepticism with tangible proof.
Ah, yes, the C-suite challenge.
Shifting a decades-old mindset, it requires more than just persuasive slide decks, right? It demands tangible, undeniable proof. What kind of proof actually resonates most effectively with leadership, especially given the high stakes involved?
It truly does demand proof. To provide it, you first need to quantify those hidden costs we talked about earlier. Map out the current backlogs, the technical debt tickets, the time to hire metrics for specialists. Then translate those delays into clear dollar and cent terms. Show the true financial expense of trying to go it alone.
Make the pain visible.
Make it unavoidable. You also need to elevate success stories. Highlight specific case studies, ideally from peer institutions, banks of a similar size or in similar markets, that successfully combine their in-house teams with specialized agencies to launch high-impact features quickly. Show it can be done.
Proof from peers is powerful.
Very. The source actually states that once executives see concrete returns, and importantly, hear praise from their own internal teams, they become champions rather than gatekeepers.
Get internal buy-in first.
It helps immensely. Practical strategies here include things like a C-suite reality sprint. Invite key decision makers to a hands-on workshop. Show them the benchmark data, the gap audit highlights, maybe even some unfiltered user testing video clips. Let them co-ideate the strategy.
Get them involved directly.
Get their fingerprints on it. You can also use milestone-linked funding gates. Redesign budget approval so that the next tranche of funding is unlocked only after predefined success metrics from a pilot project are met. For example, if the external sprint improves task success rate by 20%, then release the next budget phase.
Tie funding to results. Smart.
And lastly, showcase those peer success stories relentlessly. Curate brief, impactful case studies from comparable companies, even from other regulated industries that have successfully outsourced product design. Highlight the headline results, conversion lifts, NPS improvements, market share gains. Normalize the approach and reduce that perceived risk.
Our source uses a really compelling analogy for this blend of internal and external expertise. It compares in-house design teams to diligent family physicians.
Ah, yes, the doctor analogy.
Right. Good for routine checkups, minor fixes. They know the patient, the bank's platform, intimately. Every screen, every button, every workflow. They can treat the minor usability colds. But what happens when the patient needs, like, major heart surgery?
That's where the analogy gets powerful. If your in-house team is the family physician, then a best-in-class financial UX agency is like the world's leading cardiac surgeon brought in for those really high-stakes heart conditions.
Okay, so what are those conditions in banking terms?
We're talking about things like a complete UX overhaul of the entire platform, or building a mission-critical AI personalization engine from scratch, a major brand-driven revamp, or maybe an enterprise-wide accessibility transformation to meet new standards. Big, complex, risky stuff.
The life or death operations.
Exactly. And the cardiac surgeon, the specialist agency, brings things the family physician doesn't have. They have specialized diagnostic tools like advanced imaging through deep user research, behavioral analytics to pinpoint those hidden critical defects in the user journey.
Deeper insights.
Much deeper. They offer precision execution. Targeted interventions like redesigning core information architectures, orchestrating complex component migrations across platforms, or stitching in new AI features with, well, surgical accuracy.
Less risk of complications.
That's the goal. And they provide robust risk management and recovery plans, comprehensive pre- and post-op protocols, detailed launch plans, rollback strategies, continuous monitoring after launch. They've done this complex surgery many times before.
Experience counts.
Hugely. So, to reiterate the analogy, your in-house designers are essential. They should keep your platform healthy day to day. But for those truly transformative life or death operations that redefine your digital brand, it absolutely pays to enlist the top cardiac surgeon of UX you can find.
That is a powerful analogy. It really drives the point home about needing specialized care for specialized problems. And importantly, this isn't just theory, is it? We have concrete examples of banks that actually adopted this blend, internal strengths plus world-class experts, and saw pretty remarkable results.
Absolutely. The case studies are compelling. Take Emirates NBD, for instance. They'd gone through multiple in-house revamps, but their App Store rating was stuck around 3 stars. Not great.
No.
They partnered with UXDA, consolidated several fragmented apps into one single coherent experience. The result? A 4.7-star rating, a reported 50% lift in digital activity, and they started winning Best Mobile Banking App awards.
Wow, 4.7 is huge for a bank app.
It really is. Then there's BKT from Albania. They were refreshingly honest, admitting their mobile journey felt like using an Excel spreadsheet.
Huh.
Okay.
They worked with UXDA to rebuild the core flows around self-service budgeting, introduced completely new visuals. The outcome was soaring customer loyalty, significantly reduced support costs, and they got recognized as Best Bank in Albania.
From spreadsheet to Best Bank, that's a transformation.
It is. Look at my chat money in Mauritius. They transformed a basic payment wallet into what they call the island's first financial lifestyle super app. They hired an outsourced agency for this vision,
A big bet.
a big bet that paid off. They reached 300,000 users, signed up 200 partners, and created a whole new revenue engine for the company.
Incredible growth.
And LiveX, which is actually an offshoot of Emirates NBD targeting younger demographics, they hired external help specifically to build an entire family financial ecosystem.
Family ecosystem.
Yeah, LiveX for millennials, a really futuristic Vision Pro prototype, and even Live Light for kids aged 8-18. They won multiple awards, but more importantly, they opened up a pipeline of potentially lifelong customers by teaching money skills early in this game-rich environment.
Building loyalty from a young age. Smart. Very smart. Then CRDB in Tanzania. They completely rethought their SIM banking app, literally from the logo outward. New neon on dark visual identity, biometric onboarding, much better fee transparency.
A total refresh.
A total refresh, collaborated with UXDA. They managed to digitize 70% of their core processes, won Best Banking App nationally, and significantly push forward financial inclusion metrics in the country.
Real impact.
Definitely. And one more, Garanti BBVA Securities in Turkey. They bravely decided to dump a restrictive white label trading stack that everyone uses.
Risky move.
Very. They worked with UXDA to build a completely unique, brand-aligned, cross-channel e-trader platform. It just launched in September 2024 and immediately earned them the most innovative brokerage firm accolade.
Wow, these aren't just small tweaks, are they? These are fundamental shifts driven by bringing in that external expertise.
Exactly. They're transformative projects.
If we connect this back to the bigger picture, it raises that important question about investment, doesn't it?
It certainly does.
If banks are serious about the future of their services, the source emphasizes it's essential to allocate sufficient funding for this kind of design and transformation work.
Absolutely critical. You can't expect transformative results on a shoestring budget. The source gives a useful point of reference. Think about physical architecture. Architects typically charge around 10–15% of a building's total construction budget just for the design work.
Okay, 10–15% for design.
Right. Now apply that to complex digital projects, like building a comprehensive digital banking platform that includes mobile apps, desktop banking, maybe integrating the CRM system. The total build cost for something like that can easily run into the tens or even hundreds of millions of dollars.
Hundreds of millions, wow.
For a large, complex institution, yes. So the design phase alone minimally requires funding in the hundreds of thousands of dollars. And for a full digital banking ecosystem redesign, it can easily exceed $1 million just for the strategic design and UX work.
$1 million plus for design. That sounds like a lot, but maybe not compared to the total build cost.
Exactly. It's a fraction of the total investment. But it's arguably the most critical part for determining success.
Yeah.
Now, can it be done for less?
Yeah. Can you cut corners?
Technically, yes, you probably can find someone to do it cheaper, but the likely result will be a generic, maybe a copy-paste solution that completely fails to differentiate your brand or meet specific customer needs.
You get what you pay for.
Pretty much. In the long term, that leads to poor user engagement, frustration, and eventually a steady outflow of customers to competitors who did invest in a superior digital experience. Cutting corners on the design phase often proves to be a classic false economy in the long run.
What a fantastic deep dive. It really clarifies that this isn't about, outsourcing control or admitting defeat internally.
Not at all.
It's about outpacing stagnation. It's about strategically blending strengths to build the kind of financial future that customers, your internal teams, and even shareholders can actually believe in.
Absolutely. It comes down to systematically exposing those capability gaps we talked about, quantifying the hidden cost of inaction, and then delivering some unmistakable early wins through targeted external engagement. That's how you can effectively shift the executive mindset.
Shifting from we can do it all ourselves to
we must blend our internal strengths with world-class external experts to win. It becomes an inside-out approach to driving real innovation.
So the final question for you, our listener, is what insights will you bring to your next strategic discussion about digital innovation now that you've taken this deep dive with us?
Food for thought.
Definitely. Thank you so much for joining us on the deep dive.